at the main point of interest and buying. But whatever you do, you have to make sure that it pushes market close to at least 50% of that last move, even if it's a spike, but at least push market close, just to show that there's momentum in that breakout or in that structure shift. There's momentum there. Sometimes, even if it does not do at least that 50%, it may hold sometimes. But for me, the one I look out for that gives me a strong insight that yes, the people that broke this now to the buying side, the buyer is actually very strong because they were able to push this market up after the first pullback. So that is it. So that is what a valid inducement is, a pullback. The first valid pullback market makes after a break of structure or a market structure shift. An inducement is a trap, it's liquidity. Whenever you see an inducement, markets will come back, strip that inducement, and trigger the main point of interest. So people that inducement is now inducing early traders to think that okay, market is going to reverse from here. This is where I'm going to start taking my trade from, and they will rush into the trade and eventually get stopped out. And market will still go in their direction, but it will hit their stop loss first. They have been used as liquidity. They were induced early into that trade. That is what inducement is. It's a trap, and that is what I use as my liquidity before my point of interest. So in this case, market was on an uptrend, making higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs, then he made a lower low. This was the market structure shift. And I said the inducement in the first pullback after, remember, I did not say before, I said after a market structure shift or a break of structure. So now that there was a market structure shift, we have gotten our market structure shift. So what is the next thing we look out for? Inducement, the one that comes after it. So this was the first pullback, and this is what our inducement is here. Place that the first pullback. So this is our inducement. It can be multiple candles, can be one single candle that just pulls back a bit. Everything depends on time frames. And before you ask, there is no specific time frame I use for analysis. I do multi-time frame analysis. If market is too volatile, I can go down to even 1 minute time frame because that's when I can see the rest of the the other consecutive candles. Because on the higher time frames, it's just going to be one single candle because market is very volatile. If market is very normal, I can use 15 minutes, 5 minutes, but there's no specific time frame I use. So don't come and start asking me questions about time frames. I do multi-time frame analysis. I don't use one single time frame. For the inducement, it can be multiple candles. It does not have to be one single candle. You just have to mark the one that looks cleanest to you, provided that all the rest of them are in the same zone and in the same environment. Was one of the questions that people are going to start asking me now. I've faced it the first time and I don't want to face it again. So the inducement is the first valid pullback market makes after a market structure shift or break. So this is the one for the market structure shift for markets breaking structure to the downside. This is the one for markets breaking structure to the upside. So this was this market structure shift. After that, you see markets make a pullback. So this is like the pullback that markets will make. After making that pullback, you push up towards the direction that the shifted structure to. So this right here is our inducement. Right. Let me also mark out the inducement for your break of structure. But this one is for the market structure shift. Here is for break of structure, US. So this should be your inducement. Market to make a first pullback, then continue going in that direction, shift the structure. So this is your inducement right here. So this is your inducement. So the inducement is a trap, like I said. It's what liquidity is. Liquidity is places in the market that has to be swept. Once liquidity is swept on one side, market will head to the other side to sweep the other side liquidity. So if liquidity is taken from this side, market is heading to this side to take out the other side of the liquidity. That is what liquidity is. So the inducement is a trap in the market. Market will eventually come down or come up to sweep that liquidity. By sweeping it, I mean go out and then go below that liquidity zone and trigger the main point of interest, or eventually selling or buying. That is what inducement is. It's a trap in the market, a first valid pullback that market makes after a market structure shift or a breaking of structure. So that is my liquidity part of my strategy. Now it's time to go to the point of interest part of my strategy. Now there are 2 points of interest that I make use of the order blocks and I make use of the breaker blocks. I'm just going to take the order block in this class. Then the next class I will take the other block and then the breaker block. Most times you can see your market structure sheet or your broker structure. You can see your liquidity and you can see your order block, and then you take a trade from your order block and price does not even get to your order block and it just starts buying because price bought from another point of interest. So knowing what to use your order block and knowing what to use your breaker block is actually very important. That's why there are rules that has been implemented for giving a point of interest. There are 4 rules that has been implemented for giving a point of interest. Well, first of all, let's talk about the order block for this particular class. So I've talked about market structure. I've talked about the 2 things I pay attention to for the market structure part of the strategy, which is my market structure sheet and then my break of structure. And the 2 things I pay attention. And I talked about liquidity. I said that my liquidity for this strategy is my inducement. That the inducement is the first valid pullback that market makes after a market structure shift or a break of structure. Now we start to talk about the point of interest part of the strategy. So I make use of 2 points of interest. I make use of the other blocks and the breaker blocks. So other blocks, breaker blocks. So these are my 2 points of interest, my other blocks, and then my breaker blocks slash mitigation blocks. So what is an order block? Another block are those zones in the market where there are a lot of institutional orders. Now, people that trade with $100, $10,000, even $100,000, they really do not make any significant move in the market. There are people that trade with billions of dollars, $500 million, $1 billion. There are people that actually make moves in the market makers, institutional traders. So those places in the market where they place their limit orders, their buy and sell orders, those are what the places that we call order blocks. So we have 2 types of order blocks. We have the bullish order block and we have the bearish order block. The bullish order block for when you're looking for buys in the market, and then the bearish order block for when you're looking for sells in the market. So for the bullish order block, this is how the bullish order block looks like. You see a bearish candle, and then you see a bullish candle kind of engulf it like this. So this is what a bullish order block looks like. So you see a bearish candle like this. Sorry. Yeah. You see a bearish candle, then you see a bullish one engulf it. Depending on your chart color. So either is blue, red and blue or red and green, but this is how it normally looks like. This is the shape of a bullish order block. And then for a bearish order block, see a bullish candle, then you see a bearish candle engulf it like this. So this is a bearish order block. So bullish order block and then bearish order block. So bullish order block is when you're looking for buys in the market, and then the bearish order block is when you're looking for sells in the market. And normally for you to take your trade for the bullish order block, you take your trade from this demarcation right here. If you want to take a sell, take your sell from this demarcation right here. So you just come out and place your, if for sell, you just place your sell order here and put your stop loss just below the invalidation of that particular